move that sent shockwaves through global markets. China has just banned all oil imports from the United States, instantly wiping out a staggering $300 billion, 0 cents, in energy trade deals. This isn't just a diplomatic snub. It's a calculated economic strike against one of America's most critical export sectors. For years, the U.S. counted on China as a key buyer of crude, but that door just slammed shut. Permanently. Yeah. Now, tankers are rerouting, oil futures are crashing, and Washington is on edge. And the biggest question of all? Is this the beginning of the end for U.S. oil dominance? Because if the world's largest oil buyer walks away, who's next? In August 8th, Beijing made it official. All active and pending U.S. oil import contracts are canceled, effective immediately. The Chinese Ministry of Commerce released a terse but powerful statement, citing economic security, pricing instability, and geopolitical aggression as reasons for the ban. At the stroke of midnight, Chinese state-run energy firms, including Sinopec and CNPC, began diverting oil orders away from U.S. suppliers, opting instead for deals with Russia, Saudi Arabia, Iran, and BRICS Plus partners. The message was clear. China no longer considers U.S. energy reliable. In the past year alone, China imported over $300 billion, 0 cents, in U.S. crude and refined products, making it one of Washington's largest energy customers. But tensions over Taiwan, tech sanctions, and U.S. naval movements in the South China Sea have pushed Beijing to take a hard line. The result? American oil giants like ExxonMobil and Chevron saw stock prices fall within hours. Shipping routes through the Pacific are being redrawn, and OPEC members are quickly recalculating their production strategies. This isn't a short-term disruption, it's a structural decoupling. And for the global oil market, it marks the most dramatic realignment since the Arab oil embargo of the 1970s. China's sudden ban on U.S. oil isn't just about energy. It's about strategy, sovereignty, and survival. For years, Beijing watched as Washington weaponized trade, imposing tariffs, banning tech exports, and blacklisting Chinese firms. Energy, until now, remained one of the last stable pillars of U.S.-China relations, but recent events shattered that foundation. The tipping point? New U.S. sanctions targeting Chinese shipping companies involved in oil transport through the South China Sea. Beijing interpreted this as a direct threat to its energy lifelines. In response, it didn't just retaliate. It rewrote the rules. By severing oil trade with the U.S., China is sending 3 messages. 1. It won't tolerate American interference in its maritime or economic affairs. 2. It has enough alternative suppliers through BRICS, Plus, and the petro-yuan system. 3. It's ready to accelerate de-dollarization. Behind the scenes, China has been building long-term energy ties with Russia, Iran, Venezuela, and Gulf states, often trading in yuan, rubles, or gold. Cutting out the U.S. isn't a gamble, it's a calculated pivot. And if China can survive and even thrive without American oil, it signals a dangerous precedent for the future of U.S. export leverage. The immediate impact on the U.S. oil sector has been nothing short of catastrophic. Within 24 hours of China's announcement, oil stocks on Wall Street plummeted. ExxonMobil, Chevron, and ConocoPhillips saw losses ranging from 7% to 12%, wiping out billions in market value. Gulf Coast refineries that were tailored for export-grade crude to China now face massive oversupply and shrinking margins. Ports in Texas and Louisiana are reporting a sharp drop in outbound shipping activity, with oil tankers rerouted or forced to anchor without buyers. Independent shale producers, already battling high debt and inflation, are warning of job cuts, project delays, and possible bankruptcies. But it's not just oil companies feeling the squeeze. Rail, pipeline, and logistics firms built around the U.S.-China energy corridor are facing sudden cancellations. States like North Dakota and New Mexico, heavily reliant on oil exports, are bracing for economic aftershocks. Analysts estimate the U.S. could lose $40, 0 cents, to $60 billion, 0 cents, in oil revenue over the next 12 months if Chinese contracts remain suspended. And more critically, Washington may struggle to find a buyer big enough to fill the vacuum China left behind. For America's energy empire, this may be the beginning of a slow, painful contraction. Bob, China's oil ban isn't just an economic blow. It's a direct hit on the foundation of U.S. global power, the petrodollar. For decades, the global oil trade has been dominated by the U.S. dollar. Nations had to buy dollars to purchase oil, giving America a powerful advantage, unlimited demand for its currency, and the ability to print debt without fear. But now, China is actively dismantling that system. By shifting oil purchases to yuan-based contracts and locking in long-term deals with BRICS+, China is building an alternative ecosystem, one where the dollar isn't required. Already, countries like Saudi Arabia, Russia, Iran, and the UAE are experimenting with non-dollar oil settlements. Now, with China, the world's largest oil buyer, cutting the U.S. out of the picture, the threat becomes real. If others follow suit, the dollar could lose its status as the default energy currency, weakening U.S. influence globally. Even more alarming? China is reportedly preparing to launch a blockchain-based petro-yuan exchange, backed by gold and state-owned banks, offering countries a stable, dollar-free route to energy security. This isn't just an oil fight. It's monetary warfare, and the petrodollar may be losing. China's oil ban has triggered immediate ripples through OPEC Plus and BRICS nations, many of whom have long desired a shift away from U.S. dominance. Russia swiftly applauded the move, offering to increase oil exports to China at a discount, all in non-dollar terms. Iran and Venezuela, both under U.S. sanctions, see this as an opening to expand their market share. Inside OPEC+, countries like Saudi Arabia and the UAE are watching carefully. While they remain publicly neutral, reports suggest both nations are quietly negotiating yuan-based pricing structures for future energy deals. Meanwhile, at the recent BRICS summit, China proposed a joint energy settlement system designed to bypass the dollar entirely and empower members with direct, multi-currency trade. The message from Beijing was clear. We have partners, and we don't need the dollar. For Washington, that's more than a policy problem. It's a paradigm shift. The global response to China's oil ban has been immediate and chaotic. Oil prices initially spiked on uncertainty, then dipped sharply as markets absorbed the long-term implications of oversupply in the U.S. and rerouted demand in Asia. Wall Street analysts scrambled, downgrading energy stocks and slashing U.S. GDP growth forecasts for the next 2 quarters. Asian markets, on the other hand, surged. Chinese and Russian energy stocks jumped, while BRICS-aligned currencies gained strength against the dollar. Investors are now shifting capital toward non-dollar energy zones, betting on the rise of regional trading blocs. Commodity traders are also adjusting models, factoring in new shipping routes, currency risks, and pricing structures that no longer revolve around the dollar. In short, China didn't just cancel oil contracts, it rearranged the map of global trade. And for the U.S., that map no longer has Washington at the center. The White House was caught off guard. In a rushed press briefing, officials downplayed the impact, calling China's move short-sighted and politically motivated. But behind closed doors, panic set in. Energy lobbyists flooded Capitol Hill, demanding immediate retaliation or compensation. Donald Trump, meanwhile, took to social media with fury, blaming the Biden administration for losing control and accusing China of waging economic war. Congress is now debating emergency tariffs and a new round of sanctions, but critics argue the damage is already done. China made its move. And America? Huh? It's still deciding how to respond. This wasn't just a trade decision. It was a seismic shift. In energy, in finance, and in power. By banning U.S. oil, China didn't just hit an industry, it struck at the core of America's economic foundation. The petrodollar, global market dominance, and Washington's ability to lead, all are now in question. The world is moving fast. Alliances are shifting. And for the first time in decades, the U.S. isn't calling the shots. Because when the largest oil buyer walks away, the rest of the world starts watching